Our speaker is Mr. Cha Chi Kyung. Mr. Cha is a lecturer of Department of Banking and Risk Management from Faculty of Business and Finance, Utah, which is located at Kampar campus. So he obtained his Master's Science Finance at University Utara, Malaysia. He obtained his Bachelor of Economy Honors at Applied Statistics at University of Malaya, and with a professional qualification of the CFP. And the area expertise of Mr. Cha is financial statement analysis, investment analysis, and also personal finance planning.
So what I'm going to share with you today actually is regards that risk that faced by all the banking industry in Malaysia and as well as worldwide. Okay, basically all the banks, they require to disclose all the risks in their annual reports. They require disclose, which is one of the requirements under the Basel II framework that actually operates under the three pillars. The first, the banks have to come out that capital adequacy requirement itself on the disclosure. They need to ensure when the times they're running all the businesses, they need to have that sufficient capital for themselves on the times they're dealing with all the business lines, such as the lending business or any kinds of investment business. They need to ensure the bank they have that sufficient capital to running and all that operating time to time. And the second pillars for the bank actually come from the supervisory review. For that supervisory review, the bank basically they need to come out their own assessment. The bank they have to have their internal adequate assessment process. They need to bank they have that supervisory review and evaluation process. Then to see whether the bank they have to use their internal capital adequacy to covering all the risk they can potentially face in the course of the operation and so on. Okay, and the third pillar, which is the market discipline. The third pillar, which is aimed to ensure that the banks they by making the mandatory disclosure for all the market informations. And our central bank in Malaysia, the Bank of Malaysia, they require all the banking, they require all the bank, which is they're consistent to disclose, and they must be comprehensive, disclose all the framework in their risk management practice by all the banking. So even though wherever banking they get a license, they operate in Malaysia, so they require to disclose whatever the risks they're facing, such as a market risk, credit risk, and whatever risk they face, and how the banks, any strategy they dealing with all the risks, they also have to disclose. And what are the management, okay, and how the banks itself, they come out, the review process, identify all these risks, they also have to disclose in details under that Basel II framework itself, which is the Basel II Pillar 3. And this is required by the central bank itself. And you may see on that central bank, when it comes to that requirements, so all the banks, they have a separate document. Okay, private bank, Maybank, they also have a separate document, which is the Basel II Pillar 3 disclosure. Okay, separately to see what are the risks facing by all the banks and how the banks come out all the strategy when the times they meeting all the requirements, when the times they dealing with all kinds of these risks. Okay, basically there are four categories. Actually, there are many risks facing by the banks, but the majority, the banks will be report in the Pillar 3, okay, which is under the Basel II framework itself, which is divided by four categories. So the categories risk for the banking industry based on the disclosure is the market risk. Second is the credit risk, and the third, which is a liquidity risk. And the next or the last is an operational risk. So for market risk, market risk basically the bank when the times they need to disclose is referring to that the fluctuations in the value of that positions, as well as the portfolio, the holding by the bank, in case the market value, which is going up and down. Okay, for example, let's say the bank holding any asset, whether the asset the bank is holding is a bond, or even though it's an equity, or any kinds of the asset, or in the financial asset, usually when the times that come to the market risk is referring to that financial asset. So all the financial asset holding by the bank, they will subject to that fluctuations. Okay, the value will be up and down. It depends on the market. Okay, it depends on the market interest rate environment. It will depends on the market price volatility, and it will depends on that a lot of that movement. Okay, and this is all the uncertainty. When it comes to that uncertainty, then this is the market risk, okay, facing by all the bank. So the bank have to disclose all these market risks, okay, in their annual report or in that Pillar 3 disclosure there. So in the market risk, basically the banks that have 4 categories or 4 types of the market risk when times they're dealing with all these businesses. So the first one, which is called equity price risk. Then the second is the interest rate risk. Then the third, which is the foreign exchange risk. Then the last, which is the commodity price risk. So we come to that equity price risk. Okay, I think from that you should know the bank at the times they invest in that equity. So equity price could be up and down, and a lot of uncertainty. And the bank will be suffer because of the value for the equity they're holding, which be reflected, okay, which is uncertainty due to the price movement. So other than that, okay, the bank sometimes, especially for those investment banking, they underlie some equity for all the corporates. At times they underlie for all this equity for all the corporates, then that part of equity when times they're holding, so they're also subject to that equity price risk as well. In case let's say during the after the roadshow, then the bank cannot market and promote all the equity they sell to all investors. If the bank is still hold a portions of that equity, then they also subject for this kind of equity price risk and come with that underwriting as well. Okay, but most commonly that equity price risk will be referring to. So the bank they have a holding of that equity portion. Although it's not much, because basically the banks will be much more when the time comes to that investment, will be much more holding for that corporate fixed income product, or even though for the government fixed income product rather than equity. But anyhow, that equity which is you subject to the uncertainty of that price movement as well. Then the second market risk faced by the bank is that interest rate risk. So the banks they have they're holding a lot of financial asset. So the financial asset holding by the banks, such as loan, okay, which is one of the common measures contributions by the bank revenue loan, and as well as the bank they have a lot of investments, such as the bank invest in the government bonds, or even though for corporate bonds they invest. So all those instruments they also will be subject to the interest rate movement, because the value for the bank they're holding, in case okay the interest rate increase, let's say for example the value for the bond, the price could be declined. Okay, then the bank will be suffering from that interest rates up and down, because of that value for the bond they're holding will be affected, okay, because of that interest rate which is uncertainty, and the value of the bond also could be increase or decline is due to that interest rate movement. So other than that, then the bank also have a lot of the portfolio which is they holding as a loan. Okay, for that loan, when times the interest rate increase, then it's fine for bank. Okay, but in case the interest rate, which is let's say 2 years back, the central bank cut rate, so all the bank's revenue actually is affected, because the housing loan is hold itself holding by the bank actually, which is they need to collect lesser for their interest revenue. So they will be also affect the overall net interest margin by banks. At the end also will affect the net income by the bank itself due to that interest rate fluctuations. And the interest rate also will affect that liability portion for the bank as well. The bank can have a lot of deposit, and the bank also have a lot of non-deposit liability. So for deposit and non-deposit liability, if the interest rate increase, then the bank they have to pay a lot of that, the costs that pay to that depositor. So for your depositor, it's good for you, but for bank it's not good, because they have to pay a lot of the costs. They need to pay a lot of interest to all the depositor, okay, and they pay a lot of money survey of the interest itself, a benefit to all that which is the borrowers that they lend the money to the bank itself. Okay, so this is another way the interest rate will be affected under the liability portion. So interest rate which actually will be, because of the interest rate uncertainty, they will affect the balance sheets for the bank under the asset, okay, which is the loan and investment, and also will affect that liability part for the deposit and that non-deposit borrowing as well. And nowadays the bank they are much more getting involved in that international trading business. They have holding a lot of that foreign exchange. Okay, as well as sometimes the bank also make themselves dealing with all these currencies as well. So, and some of the bank they offer lots of the foreign exchange saving accounts. Then if they're holding a lot of that foreign exchange asset as well. Okay, so let's say the banks are holding some which is the financial asset from overseas. Let's say they invest in the fixed income products in overseas as well. Then they also will be subject for all those foreign exchange risks, because of that uncertainty of the foreign exchange, the market value, okay, or the exchange rate for that other currencies could be appreciate or depreciate. So your value for asset you're holding by the bank also be which is up and down, okay, and it will affect your overall balance sheets that are holding by the bank, and at the end will affect your net worth for the banking. Okay, and last, for the commodity price risk. So basically for that commodity, the banks seldom they getting themselves to involve in that commodity in Malaysia's like CPO and so on. So the commodity price risk here majority will be referring to the gold. So the bank they have a lot of gold. Some bank they hold a lot of gold reserve. So those gold reserve, when times the gold price is increasing and decline, then actually the banks also will be subject for all those commodity price risk, okay, which is if they're holding a lot of the gold in the bank's reserve, or the bank sometimes they hold a lot of the asset, okay, which is the putting in that gold price as well. Okay, so this is all the 4 basic risk types of risk facing by the banks under the market risk, okay, categories. So other than the market risk, then the banks also face the second or one of the major risks by the bank, which is called credit risk. The credit risk is basically due to the loss of the principals or the income arising from the borrowers, or sometimes it's due to the counterparty, okay, unable to perform the contractual obligations. And why the borrowers they cannot pay back? Because depends on lots of the issue, okay, because the market scenario economy is not good, then the borrowers are unable to pay back for the installment, let's say for housing loan. So housing loan, the customer, it could be default, okay, or sometimes he can pay 1 month, but because of that 2-3 months later they are unable to perform, he return to that non-performing letter. That one is also part of the credit risk facing by the bank because of the borrower, okay, the default, or maybe they just default in the temporary, just only non-perform in temporary. It's not come to that default yet, but it's still part of the credit risk. And the bank, they also sign some contractual obligations, okay, another which is for third party. Let's say they sign a derivative contract with another counterparty. So if they have a lot of the contractual obligations or a lot of contract or sign with the other counterparty, let's say from Malaysia Bank A, they sign another contract with Bank B. So if Bank A, let's say this Bank A in Malaysia, they gain profit. If the Bank A gain profit, so what they worry for? They worry, or they're wondering that the other counterparty B, it could be run away, right? Even though their bank, they could also have the possibility they are not going to fulfill that obligation. So you gain money, you subject to that credit risk. You lost money, then you know you don't have any credit risk. You don't need to worry because you are the one who lost money. Okay, those credit risk is only affected by those parties who are gain a profit due to that contractual obligations, such as you sign a contract with another counterparty under that delivery contract, then the other counterparty, they have that possibility to run away or not going to pay back any profit to you. Okay, so this would be another credit risk facing by the bank. Okay, this is called counterparty risk. But the majority, the credit risk faced by the bank is due to that result from the lending. Okay, the lending. And for underwriting, yes, okay, you still have, but it's not that common. Trading, the bank, sometimes if they trade, such as the delivery contract with the counterparty, then the counterparty is not going to fulfill their applications, then they also will be facing the tradings, which is the credit risk as well. And investment activity from both on and off balance sheet transactions, such as the common one is the over-the-counter derivative, which means you A and the other counterparty B, you sign a contract for that derivative, but the other counterparty, they're not going to pay you all this, okay, profit rates supposed to gain for that, okay. So this is quite common, okay, in the international banking, especially you have a lot of contracts, okay, interest rate swap or currency swap or with other counterparty which is overseas, but they're not going to fulfill, not going to pay all that, okay, profit to you. And credit risk, basically they're divided by 3 categories. Okay, the first one is default. Okay, default basically is result from the bank loan. The bank, the major business is doing the lending business. So in case that the customer or the client is unable to fulfill his obligations to deliver all the installments on time, or let's say they suppose a customer for housing, then he should pay for 2,000, but because of that customer, okay, they have some financial problem, they are unable to make that home payments on time, then it could be loan, it come to that non-performing loan letters. Okay, later on slowly then come to non-performing, become a default. Okay, so all these default risk is result from the lending business, and the bank also face the credit risk, okay, in terms of that downgrade. the bank also they borrowing monies from outside. Okay, the bank also borrowing money from outside. So in case for that counterpart, your rating, okay, all the banks they have their own rating. The rating which is could be rated by all these Moody's, Fitch rating, okay, and Standard & Poor's and so on. If they downgrade your bank, so if they downgrade your bank from, let's say, from AA downgrade to A, then you have to pay a lot of that costs in the borrowing. So last time you maybe for all the non-deposit borrowing, such as you want to borrow some repo, okay, or even though for some of that NCD, negotiable instrument deposit and so on. So you need to pay let's say 3%. But because of that downgrade, then the bank have to pay more costs when times you want to borrowing from outside or you want to borrow from other bank as well. So the downgrade will be affected, okay, your bank borrowing cost. So on the other hand, okay, for downgrade risk also affect your portfolio in case you have that investment. So let's say the bank they hold a lot of that investment. Okay, you have a lot of investment, especially for that fixed income product. So the fixed income product basically they also have that rating. When times the rating downgraded, then you also have that possibility that counterparty moving to that default letter off. Okay, the downgrade which will affect your asset positions as well as will affect your liability position for the bank. And the last one, which is counterparty. The counterparty, basically you and the counterparty sign a contract. Okay, majority is that just now I did mention, which is the over-the-counter derivative. You sign another derivative, another over-the-counter derivative with the counterparty, but the other counterparty they're not going to deliver his promise by the time they lost money. So you get money, of course, you're not going to run away. Okay, the only party which is going to run away because of that counterparty who lost money, then you're not going to fulfill or not going to deliver the losses money, which is supposed to be pay to you. Okay, this is the counterparty risk. Okay, this is the things that the bank also need to face for that. Okay, because of that counterparty is not going to fulfill its obligation. And the third types of that risk facing by the bank, and this is also it should be need to disclose in that Basel 3, Basel 2, Pillar 2 requirements under the bankings. You will see all the banks, okay, they are most concerning in that annual report, or even though in that Pillar 3 disclosure is that liquidity risk as well as that credit risk. Okay, because these two is when it comes to banking, they're doing the business, actually they are much more subject to that liquidity. Why? Because when it comes to bank, they borrow money actually is for the short term. For deposit, the bank is one of the borrowing sources, deposit as well as the non-deposit borrowing is all in the short term. The deal for that deposit and the non-deposit, the longest is 1 year, or maybe it's just a few months sometimes, or even though for repo repurchase agreement is 1 day or 2 days, or even though 1 week only. So in very short term, okay, you need have to fulfill or pay back to your obligations on time. But for the revenue part for the banking, under the balance sheets, the revenue generated from that asset, they take longer term. Let's say example for the loan. If the bank, let's say they sell or they're going to have a loan, which is after they disperse. So the loan approved and dispersed, then the customer, they spend 20, 30 years to pay back all the loans. So when the times the bank have that problems for that asset and that liability, that mismatch, which is the result from that short-term borrowings, and they have to which the revenue generated from that loan as well as other investment product, which is result from all the result from the revenue from long term, then the bank will suffer for that liquidity risk because of that asset liability mismatch in that maturity. So the liquidity also they divided by two parts. One is called that we call market liquidity risk. The other one is funding liquidity risk. So what is it about? Basically, liquidity risk is meaning for you, the bank itself, if they hold a lot of asset. This is one first definition, which is called market liquidity risk, which is the bank unable to sell the security at a fair price. The bank hold a lot of asset. For example, the bank hold asset for fixed income product, a bond. So bond suppose the market value it should be 1,000. But 1,000, because due to that market liquidity is not that perfect. So the bank, they want to sell at 1,000, but no one wish to pay for that money on that particular price, which is the quoted fair. But so, of course, you still can sell, you still can sell the security, even though 1,000 you cannot sell, then you offer a discount. You offer discount such as 950, 900, 850, definitely you can sell all these securities. But is it the security you sell, okay, to the markets, okay, or to anyone who wish to purchase? Is it fair? Sometimes it's not, okay, because you need to offer a huge discounts when time you're selling all the security that you hold. So you're selling the security is not at a fair price, then this is the another liquidity risk faced by the bank. Okay, then the other liquidity risk faced by the bank is called that the bank sometimes they need to funding. Okay, they need to receive a lot of fund. Or when times they need to have a lot of money to pay all these short-term obligations. Okay, such as they need to pay that intraday payment is due on that deposit interest rate. It may be due on that non-deposit borrowing. Okay, maybe it's due on that repo, or maybe they need to pay due on the salary. Okay, even though for all the daily expenses. And they also bank have a long-term commitment as well. With the bank, they have a long-term borrowing. They also have to pay for that long-term commitments, but the bank they did not have that money. They need to find the money to pay for that. In temporary, they face that issue by the time they want to raise a fund to pay all this intraday deal. Okay, so if they face that kind of that problem, we call it's a regulatory risk as well. So bank they require the standby and some reserve requirement to the central bank. When the times the bank they need to prepare money to pay for that reserve requirement, as long as the bank they receive a deposit, they need to have a fractions of that amount, let's say 10%, have to stand by for that reserve requirement under the central bank requirement. So the bank need to prepare money for that money, okay, which is the sufficient money to funding for that reserve requirement. So if the bank, if they're unable, okay, to find that money in temporary to funding all this reserve requirement, the bank also will face that liquidity risk as well. Okay, so just now, okay, all that story, okay, what are the things that I highlighted is divided by the liquidity. Sorry, is divided by two types. Sorry. One is the market liquidity risk. The other is the funding liquidity risk. Market, okay, in summary, is just the positions that cannot be closed, and they can need to sell that equity you hold in the short term. Okay. And for funding liquidity risk, which means the bank you need to ensure they have a sufficient funding for that payment due. Okay, this is the two categories for that liquidity risk facing by all the banks, which they require to disclose all the solutions, okay, in that Pillar 3 for that annual report. And the last types, okay, of the risk, which is the bank required to disclose, okay, under the Pillar 3 is operational risk. So this operational risk, okay, is due to the losses by the bank when the times they have, okay, the problem or the issue, or is due to inadequate or failed by the internal process, or maybe the peoples, or maybe the system, or any other external event. Okay, so all these internal and external events cause the bank to lose money is called operational risk. But this, bear in mind, under the operational risk, that includes the legal risk, which is the bank, let's say they have that legal issue, okay, they need to bear a lot of that compensation due to the legal issue. So this will be categorized under the operational risk, but it excludes that strategic and that reputation risk. Strategic risk, which means the banks that which is for the long terms of business operation, they result from the business strategy. Okay, so the time the business is not good, okay, which means the banking they make a wrong the decisions on that directions, okay, under the bank operationals, okay, activities. Let's say the bank they wish to lend money for a lot of money for that special project, but unfortunately that project is failed and so on, then it will be under that strategic risk as well. Okay, because they cannot be ensure that the project which is they generate income to the banks and so on, okay, fishing for the long-term goal. And also for reputation risk, okay, for reputation risk, in case the banks they have that risk due to affected by that defamations and so on, okay, by all the public, or the public lost confidence to the banks, okay, because it's due to regulation, or maybe the banks getting involved for any money laundering activities, or maybe the banks that they have some activities which is we should affect them. Okay, all the whilst the good view for the bank. This all is not categorized under that operational risk. Okay, but legally yes, we do include. So under the Basel, okay, they divided for the operational risk by that 7 category 1, 2, 3, 4. Okay, which is internal fraud, external fraud, and so on. So these 7 category are under that Basel, okay, which is they categorize, they have again certain, which is event, they part under that 7 category. So let's say, for example, for the internal fraud. Example for that internal fraud by that operational risk like forgeries, bribes again, which is the they take some which is Russell, okay, which is the price from some party again, which is the, you give me the loan, I give you some under table money, okay. So this is also part of the internal fraud as well. And the banks they have the issue for tax non-compliance. So suppose they need to pay for that particular tax, but the bank they try to getting involved for that tax evasions, then they also will be under the operational risk and mismanagement of that asset. Okay, so the banks are misuse for the bank asset. Okay, also will be part under the internal fraud because of the staff. They use all the bank's asset. Okay, let's say the transfer the money from that one account to another account because within the authority they have the right to transfer, but the transfer without the authority is also part of that internal mismatch of the asset as well. And theft, okay, so theft under the internal fraud, which means the staff, okay, usually is resulting for the bank staff. They stolen that money from the bank, okay, so they steal all the money from the bank. Let's say the bank has a lot of cash, right? So there's some internal staff, okay, which is the, let's say a lot, they know the way the money they put, okay, they know where the money they put, and sometimes they take out, even though they have a CCTV, but the staff is no, okay, where is the hidden point the CCTV cannot detect, then they take all the money and run. But this is also belong to the internal theft, okay, which is the internal fraud as well. And it say the internal staff they perform any unauthorized activity, okay, which is the such as the transfer out lots of big money, okay, which is they say they have they know that sometimes they know the password, okay, from the customer. Sometimes because uncertainty, they know because it's not because they know from the system. Sometimes the customer they disclose to them because it for the convenience for the customer, but they are unauthorized to perform all those money transfer paid by the staff itself. So transfer from one party to another counterparty, this is also part of the internal fraud as well. Okay, unauthorized activity, this is all the part of the internal fraud. But for external fraud, which is usually by that external party, okay, such as the customer, usually it results from a client, or maybe it's a potential client also could be, or another counterparty, then we don't know, which is third party, we also don't know who is it. So example for that external fraud is the check fraud, okay, such as the check cloning, okay. So if the bank, the customer in that fund, money they don't have related, but they issue a check, which is the without sufficient fund, is also possible, okay. Clone check is most common, is external fraud. And the bank system hacking, okay, by by the hackers or by other third party, okay, which is unknown, that the one also will be part of that external fraud because we don't know who's the third party who hack into the bank system and stealing all the money. And also they have another third party, okay, which is they have unauthorized to accept all those bank information. Okay, they know the weaknesses for the bank system and they hack in. Okay, this is also which is another external event, external fraud by the third party, which is they need to, they have the rights. Again, I don't know how they're doing, but they know the system. Then they just log in and access all the bank information, and they stolen all the information, which is sometimes PNC by the client. But of course, okay, usually this one will happen for those bank they have a very weak firewall. Okay, if the bank they have a very strong security system, is certain, but somehow okay, it's not all the banks perfect. Some of the bank they just recently develop, okay, and still in the enhancement, okay, of that system, then they could be have a lot of the unauthorized access to the bank information here. And the third, okay, operation risk faced by the bank is the employment practice and the workplace safety, such as the bank actually to ensure the safeguard of the health of all the employee and the staff, and the safety, okay, to ensure the safety. Okay, even though you sit in the counter, it could be have a lot of things. Then this issue will be faced by for during the COVID time. Okay, so the bank actually they closed the door and they limited a lot of the head count to enter to the banks, which is the bank branches. So for one time they need just permitted for only 5, okay, which is the customer to enter to the premises only. So more than that, they're not allowed. Also, you have to queue outside, okay, for that. Because of that safety concern, okay, maybe the safety is for that staff as well as the customer, okay. And they also need to ensure that general well-being for both employees and the customer as well. So make sure all the, for all the things that in the bank itself, you need to they have that security, okay, and must be well performed. The ATM, they will certainly expose themselves. Okay, this is also need to keep on checking, okay, make sure the ATM all in order and so on. Or okay, sometimes the staff they have all this unethical termination. So without no reason, then it has been terminated by all the bank. So this is also another employment practice. This is also part of the operational risk by the bank. And the bank, they have some, let's say, race discrimination, or even though for gender discrimination in the workplace is also part of the operational risk. And next, the client's product and the business practice, okay, for that operational risk will be like the bank staff, which is they perform, when times they perform the duty is unprofessional, okay? So they are not going to explain all the information which they're supposed to explain, all the risk profile, okay, which they need to assess, need to explain to the clients for all the terms and conditions, but they behave unprofessional. Okay, they don't let the customer know some of the details and so on. Okay, and maybe the banks that have that fiduciaries breached by some of the bank staff. Okay, they're not going to tell all the truth. They're not going to loyalty to the clients. Then they try to pass again, which is some of the misuse some of the client confidential data and transfer out to the third party and ask the third party to call or contact the client. Because of that, they know that client informations and some of the private details again, or maybe the wealth information for the client, which is much more confidential, but they just disclose and misuse all this information to the other party. And money laundering, yes, okay, this is also part of that clients, products, and the business practice as well, which is also part of the operational risk, okay, which is the bank staff, or even though the clients, okay, sometimes not bank staff is the client. Client, they lend their personal account for another third party, which is the user account to launch all the money. This is also part of that operational risk. And next, the fifth one for the operational risk is the damage to that physical assets, such as that natural disaster. Okay, I think the December 2021. So we have that flood in around the around Malaysia. Then some bank branches unable to operate due to the flood. Okay, so this is also part of that natural disaster. Some country they have that earthquake and so on. That one also natural disaster that make the bank that damage to that whole building will be damaged. Okay, there's also will be damaged. It cannot perform. Okay, its daily operation is also part of that operational risk. And terrorism and vandalism also same thing. Okay, so they make the ATM machine, okay, cannot be functions, or make the banks they just they have some terrorism. Okay, let's say they try to boom the bank, that the bank also cannot be operated, right? So this is also you make the bank damage to that physical asset and it cannot be operated. And next, business disruption and the system failure. Okay, this is quite common nowadays, okay, because of that system and hardware malfunction. Okay, such as we always heard when come to the bank branches, then the bank start telling you, oh, system hang today, system down today. So why this happen? Because this is also part of operational risk. This is also one of the reasons, okay, the bank it cannot be operate the operational activities which is smoothly. So example like this, power outage, the software crash, and the hardware malfunction, okay, system down, system hang available, then all the business disruption because of that system. And nowadays, they're no more using manual. All the banking operation, it must use a computer to connect each another. So all the system information must be accessed to the internet system by the bank. So all the client information also will be appear in that computer screen only. So you cannot just check the file manually, okay, from all the bank branches nowadays. So if any things happen, okay, or the business system fail, then it cannot again operate immediately. Okay, so the bank you cannot do anything. So it's also part of operational risk. And the last type of operational, which is the executions and deliver and process management, which is the bank. Let's say the failure of to execute the transactions, okay, which is, let's say the banks, they approve a loan, but there are a lot of problems there, okay, because of some documentations or because of that lawyers, legal problem, or maybe it's an internet problem. The bank, it cannot execute certain transactions, okay, and for that loan for disperse, or even though the bank, let's say, dealing with that transaction, acting trading activities. For those trading activity, the bank want to let's say execute an order for buy, but due to the system or maybe because other issue, then the bank cannot be execute that order or that transaction correctly, or maybe they want to click buy, they click sell, okay? And this is also will be under the execution and delivery process management. Okay, such another common issue is such as when times you enter the data entry errors. Okay, you keep normally I mean the data entry stuff, you want to key in the bank customer names, IC number, and so on. Okay, or maybe the bank, they have unfinished backlog, so no one to follow up. Okay, so there are a lot of documents which is they put there and no one follow up at the end, then you just left it there. Okay, so a lot of backlog which is unable to complete on time and so on. This also will be part under that operational risk, under that execution and delivery process management. Okay, and this is all the sharing from my part, right, under the banking's risk in the banking industry that's facing now today, which is they require to disclose all these risks in that Pillar 3 under the Basel II framework, which is required by the central bank. Okay, and thank you very much. Now, Doreen, back to you.
Okay, thank you, Mr. Chia, for sharing this amazing information to all of you. So I believe they learned a lot from you today. So we got one program that is related with risk, which is Bachelor of Business Administration Honors in Risk Management. This program is aimed to provide students with a broad understanding of risk management of financial and non-financial cooperation, and core curriculum include analytical knowledge, operation management, legal framework, and also strategy planning. And this program also to provide students with solid theoretical knowledge, case study that are parallel to the current changing business environment, and hand-on practical and risk analytical technique. So this program is a duration for 3 years, and we got 3 intake for this program, which is January, May, and also October. It is located at Kampa campus, and you may also refer to the career prospect that we are risk out. For example, a risk control consultant, risk management executive, or manager. So here come to the end of today's live webinar. Last but not least, today's webinar will be recorded and will upload to our YouTube channel. For further inquiry, you may contact us through WeChat, WhatsApp, and also Facebook. Thank you for joining us today and have a nice day.